When planning to purchase a home, knowing the difference between what you qualify for and what you can afford is key. Brand the Mortgage Man here, and I've helped more than 10,000 home buyers over my 22-year career, putting me in the top 1% of loan originators nationwide. And something I always make sure to discuss with my clients is where they're comfortable when it comes to a monthly payment, meaning what they can afford. In this video, I'm going to discuss the difference between mortgage affordability and mortgage qualifying, how to effectively budget, how lenders calculate mortgage affordability, 3 factors affecting mortgage affordability and strategies to improve them, and some examples of how interest rates affect mortgage affordability. So let's get into it. So first off, let's talk about mortgage affordability, which is really your perspective. Mortgage affordability refers to how much you can comfortably afford to pay each month for a mortgage based on your personal financial situation. It's an estimate of what size loan you can realistically take on without stretching your finances too thin. Mortgage affordability considers your income, living expenses, and any existing debts to help determine a payment amount that you can handle comfortably. So what are some of the factors that affect mortgage affordability? Well, income is a big one. Your total household income, including salary, bonuses, commissions, and other sources of regular income need to be considered. Your living expenses, your other monthly expenses such as utilities, transportation, food, childcare, etc. need to be thought of. The amount you're putting down, your down payment, the amount of money you can contribute up front, which reduces the total loan amount and affects your monthly payments. Interest rates are a factor. The interest rate affects your monthly payment. A lower rate can make a higher loan more affordable, while a higher rate will increase your monthly payments. In essence, mortgage affordability is how much you believe you can afford to pay for a mortgage without jeopardizing your financial stability. It's more about your comfort level and financial well-being than just what a lender says you qualify for. Which brings me to how a mortgage lender qualifies you for a loan. And that's the lender's perspective. When a lender qualifies you for a mortgage, they are evaluating your financial health and creditworthiness to determine how much of a loan they're willing to extend to you. This process involves a detailed review of your financial profile, and a lender uses strict guidelines to assess whether you're a good risk for lending money. Key factors that lenders use to qualify you are pretty much all the same of what you would use to determine your own affordability. The difference is the guidelines set a debt-to-income ratio limit, and this is the ratio that helps lenders understand how much of your income goes toward paying debt. In essence, the lender qualifies you based on their guidelines and risk tolerance. They use their assessment to decide if you're financially capable of repaying the loan and whether they are willing to lend you the money based on your financial profile and the property's value. So what are the key differences between affordability and qualification? Well, for one, affordability is subjective and based on your own comfort level with monthly payments. It's about determining what you can afford without stretching your finances too thin. Qualification is objective and determined by the lender based on their criteria. It's about proving to the lender that you meet their standards for income, creditworthiness, debt load, and other financial factors. Affordability, again, considers factors like your overall financial well-being and goals. You might feel comfortable with a certain monthly payment, but this doesn't mean the lender will approve you for that loan amount. And qualification, again, is more focused on financial metrics like your credit score, debt-to-income ratio, income, and savings. A lender will use these to decide how much loan they're willing to extend to you, regardless of what you believe you can afford. For example, let's say you earn $75,000 a year, have $20,000 in savings, and want to buy a $300,000 house. From your perspective, affordability, you may feel comfortable with a monthly mortgage payment of $1,800 based on your budget and expenses, and you've calculated that you can afford this payment without strain. From the lender's perspective, qualification, the lender will review your credit score, verify your income, check your debt ratio, and make sure you have enough savings for the down payment and closing costs. Based on their criteria, then they approve you for a loan amount and mortgage payment that aligns with their guidelines, which could be higher or lower than what you felt was affordable. Mortgage affordability is about what you believe you can comfortably afford to pay each month, while mortgage qualification is about whether you meet the lender's specific financial criteria to be approved for a loan. Both are important when deciding how much house you can buy, but they serve different purposes in the home buying process. Understanding both will help ensure you make a financially sound decision that aligns with your personal budget and the lender's requirements. So how do you effectively budget for a home purchase? Well, effectively budgeting for a home purchase involves planning for several key financial aspects to ensure you can afford the costs of purchasing a home, including the down payment, the closing costs, and ongoing homeownership expenses. A well thought out budget helps you manage your finances, avoid overextending yourself, and make the home buying process smoother. So here's a step-by-step guide on how to budget for a home purchase. Number one is you want to determine your price range and know what you can afford. Before you even start looking at homes, you need to figure out how much you can afford to spend on a house. This goes beyond just a listing price. It involves considering your financial situation in a broader sense. You want to think about your income. Calculate your total household income, including salary, bonuses, commissions, and other sources of regular income. You want to know your debt-to-income ratio. Lenders use your debt-to-income ratio to determine how much debt you can afford. The general rule is to keep your debt ratio below 50%. And this is going to include all of your debts, including the new property. Next, you want to consider your mortgage payment. Use a mortgage calculator to estimate your potential monthly mortgage payment based on different home prices, interest rates, and loan terms. Make sure to include property taxes, homeowner insurance, and possibly private mortgage insurance, or PMI, if you're putting less than 20% down. Next comes affordability guidelines. As a general rule, aim for a home that costs no more than 2.5 to 3 times your annual household income. For example, if you make $75,000 per year, look for homes in the $180 to $225 range, depending on local market conditions. Next, you want to save for a down payment. The down payment is one of the most significant upfront costs when purchasing a home. The amount you need depends on the type of loan you choose and your personal financial goals. For conventional loans, they typically require a down payment of at least 3% if you're a first-time home buyer. For FHA loans, which is through the Federal Housing Administration, you can put as low as 3.5% down. And for VA and USDA loans, you can actually get those with no money down. You also want to save aggressively. Start saving for your down payment well in advance. Set a target goal based on the average home price in the area you plan to buy. For example, if you're looking at a $250,000 home and want to put 20% down, well, that's $50,000. Budget for additional upfront costs as well. In addition to the down payment, you'll need to budget for other upfront costs associated with purchasing a home, such as closing costs. And closing costs can range from 2 to 5% of the home's purchase price and include fees from the title company, the lender, third parties. So for a $250,000 home, this could be $5,000 to $12,500. You are also going to have a home inspection and an appraisal you need to pay for. And expect to pay for those up front. That can range $300 to $500 for an inspection. An appraisal can range from $500 to $1,000, and it's required by the lender. You also want to think about your moving costs. Don't forget to budget for moving expenses. Whether you're hiring professional movers or renting a truck and doing it yourself, this can vary greatly, but plan of at least $500 to $2,000 plus, depending on the distance and volume of your belongings. You also want to think about homeowners insurance. Lenders are going to require you to have homeowners insurance on the property, and that can range substantially depending on where you live. Talk $1,000 a year or $10,000 or more per year, depending on the home and the location. You also want to account for ongoing home ownership costs. Home ownership comes with ongoing costs that you'll need to budget for on a monthly or annual basis. Things like mortgage payments. Your monthly mortgage payments will be the largest ongoing cost, including principal and interest, property taxes, homeowners insurance. If you put less than 20% down, you have PMI, which is mortgage insurance. And those property taxes, property tax would be a significant expense depending on where you live. Be sure to research the property tax rates in the area you plan to buy, as this can impact your monthly budget. You also want to think about utilities. You want to estimate the cost of utilities like water, electric, gas, internet in your new home, because utility bills can vary greatly depending on the size of the home, the climate, and your usage habits. You also want to think about maintenance and repairs. As a homeowner, you'll need to budget for regular maintenance like lawn care, cleaning, seasonal upkeep, as well as unexpected repairs. A good rule of thumb is to set aside 1% of your home's value per year of maintenance. For example, on a $250,000 home, that's $2,500 annually, or about $200 per month. You also want to think about homeowners associations or HOA fees. If you buy a property in a neighborhood with an HOA, you'll likely pay monthly or annual HOA fees for community upkeep, amenities, and other services. These fees can range from $100 to $500 plus per month depending on the community. I recommend you create a detailed monthly budget, and once you've accounted for the down payment, closing costs, and ongoing homeownership expenses, create a detailed budget that includes all of your income and expenses. Consider using budgeting tools or apps to track your spending. Consider your income. List all sources of your income. Consider your expenses. List all monthly expenses. Make sure you consider groceries, gas, everything. Think about an emergency fund. Having an emergency fund is crucial when owning a home, as unexpected repairs or financial challenges can arise. Aim to save at least 3 to 6 months of living expenses that can easily be accessible in an account. You also want to consider long-term affordability. A home is a long-term financial commitment. Before committing, ensure that your future financial plans align with your home purchase. You also want to think about job stability. Make sure you have a stable source of income and job security to afford ongoing costs of homeownership. Your lifestyle goals are key. Ensure your home purchase doesn't compromise other financial goals, such as saving for retirement, college education, or major life events that starting a family or travel. Think about future costs. Consider potential future costs like an increase in property taxes, HOA fees, or changes in mortgage interest rates if you have an adjustable rate mortgage. Budgeting for a home purchase requires planning and discipline. Start by understanding how much you can afford based on your income, debt, and desired monthly payment. Save for a down payment, closing costs, and any other upfront expenses. Don't forget about ongoing costs like mortgage payments, property taxes, insurance, utilities, and maintenance. By creating a comprehensive budget and factoring in all of these elements, you can confidently prepare for the financial responsibilities of homeownership without overextending yourself. Now, that's for yourself to do, but how do lenders calculate mortgage qualifications? Well, to calculate mortgage affordability based on an annual income, we need to consider several factors that a lender is going to look at, which includes your debt-to-income ratio and the general affordability guidance used by most lenders. And here's how we can break it down using an annual salary of $50,000. Step 1 is to calculate your monthly income, and you do that by converting your annual income into a monthly income figure. All you need to do is take your monthly income and divide that by your annual income, and divide that by 12. So your monthly income, $50,000, let's say, we divide that by 12 equals $4,167 per month. Step 2 is to calculate your max monthly payment. Lenders typically recommend that your debt ratio, it's a little bit high, but they typically recommend your debt ratio does not exceed 50% of your gross monthly income. So $4,167 times 50% equals $2,083.50 per month. This amount would include the mortgage, tax, insurance, HOA fee, and any other items appearing on your credit report. So it doesn't factor in utilities and things of that nature, but car payments, credit cards, student loans, anything you might have on your credit report is considered. The important thing to consider when it comes to a lender's calculations is that it's based on your pre-tax income. This is why it's important for you to determine a payment you are most comfortable with based on your take-home income, since that's what you have to pay your bills with and actually have available. Now, what are the factors that affect mortgage affordability? Well, when determining mortgage affordability, several factors come into play that can impact the size of the loan you can qualify for and your ability to comfortably make monthly payments. 3 of the most important factors affecting mortgage affordability are your income, your debt ratio, and your credit. So let's discuss each. First is your income. Your income is the foundation of your mortgage affordability. Lenders will look at how much you earn to determine your ability to make monthly payments. The more you earn, the larger the mortgage payment you can afford. So what are some strategies to improve income? Well, increase your income. Look for opportunities to boost your earnings. This could involve asking for a raise, taking on a higher paying job, or starting a side business. Work overtime. If your job allows for overtime pay, this could increase your income and improve your mortgage affordability. Diversify your income sources. If possible, consider additional income streams like freelancing, investing, or earning rental income. This could help strengthen your financial profile. Reduce gaps in employment. Long periods of unemployment or part-time work can hurt your mortgage application, so maintaining steady employment history is beneficial. Next is your debt-to-income ratio, or your DTI. And your DTI ratio is a key factor lenders use to determine your ability to take on more debt. It compares your monthly debt payments to your gross monthly income. A higher DTI ratio indicates that you already have significant debt obligations, which can reduce the amount a lender is willing to approve you for a mortgage. So let's just say you have a high debt-to-income ratio, above 43%, may make it difficult to qualify for a loan or result in higher interest rate. When a lower DTI, like something below 36%, demonstrates you have more financial flexibility to handle a mortgage payment. So what are strategies that you can do to improve it? Well, pay down existing debt. Reducing credit card balances, paying off car loans, or eliminating other monthly obligations will lower your debt-to-income ratio and improve your chances of mortgage approval. You can consolidate or refinance debt. Consider consolidating or refinancing high-interest debts to lower monthly payments, which can reduce your debt ratio. Avoid taking on new debt. Avoid opening new credit cards or taking on additional loans before applying for a mortgage. Even small amounts of new debt can push your debt ratio higher. Increase your income. I know it's easier said than done, but as mentioned earlier, increasing your income can improve your DTI by providing more income without adding additional debt. Finally, your credit score. Your credit score plays a significant role in determining the interest rate you'll receive on your mortgage. A higher credit score generally qualifies you for a better interest rate or a lower interest rate, which can make a mortgage more affordable over time. A lower credit score can result in a higher interest rate, which means higher monthly payments, larger total cost, over the life of the loan. Excellent credit, which would be 780 or above, will result in the lowest possible interest rate available. Fair or poor credit, which is anything I would say below 660, can result in higher interest rates, sometimes 1 to 2 percentage points higher than the rates for those with excellent credit. So what are some strategies to improve your credit? Well, for one, pay your bills on time. Timely payment of credit cards, loans, and utilities has a significant impact on your credit score. Consistently paying bills on time helps demonstrate financial responsibility. Reduce credit card balances. Aim to keep your credit card balances below 30% of your credit limit. This shows that you're not over-relying on credit and improves your credit utilization ratio, which can boost your scores. Avoid opening new credit accounts. Each time you apply for new credit, a hard inquiry is made on your credit report, which can temporarily lower your score. Try to limit new credit inquiries until after your mortgage is approved. Fix errors on your credit report. Regularly check your credit report for errors or inaccuracies and dispute any incorrect information that may be negatively affecting your score. So, how do mortgage rates affect home affordability? Well, for the purpose of this exercise, we're going to use a $500,000 home with 20% down while comparing the monthly payments at both 6% and 7% over 30 years. So on a $500,000 home with 20% down, your loan amount would be $400,000. So at a rate of 7% over 30 years, your principal and interest payment is $2,661.21. Now, on the same home, if the rate were a full percent lower at 6%, your principal and interest payment is $2,398.20, a savings of $263 per month or nearly $95,000 over a 30-year term. Knowing the effect an interest rate can have on home affordability can help in determining the best route to take with financing your home. There are products and programs in the market that provide ways to lower your interest rate without any additional cost to you, all while making the home more affordable. So make sure to take advantage of them. Determining what you feel you can afford should be the first step before entering the home buying market. Once you've done that, connect with a mortgage professional for guidance on getting pre-approved for a mortgage. If you found this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.